Good afternoon, everybody. My name is Katie Ensweiler. I'm the marketing manager here at Von Lehman, CPA and advisory firm. A huge thank you to our continued partners on this series, Haran and Graydon. We absolutely couldn't do it without them. We are joined today by Jovana Krajewski and Carrie Walls, who are going to go over retirement plans with audit findings and how you and your companies can prepare for the new year. We are also joined by Travis Garrett, who's a controller with Wings and Rings, who's going to offer some firsthand experience as well. Before we get started, just so you know, we are recording today's session. So if there's something that you miss, we will send out the link so you can watch it at a later date. If you have any questions, please feel free to put them in the chat feature and we'll do the very best we can to get to them. We will be sending out our panelists and presenters information today. So if you have any questions and need to reach out to them directly, you absolutely can. So with that, I will go ahead and turn it over to Jovana.
Thanks, Katie. Good afternoon, everybody. My name is Jovana Krajewski. I am an audit manager here at Von Lehman. I've been here for a little over 11 years. I started as an intern when I was at Northern Kentucky University. I've been here ever since. I co-lead our ERISA service line here with Carrie Walls, who's on this call as well. Carrie?
Yeah, my name is Carrie Walls, and I'm a manager at Von Lehman as well, and I'm in the assurance area. I joined Von Lehman in 2013, and I specialize in employee benefit plan audits. I guess, John, do you want to introduce yourself?
Sure, thanks. So I'm John Kirk. I am an attorney at Graydon. I lead our employee benefits and executive compensation group. And so I'm sort of the guy who, when the audits go bad or find something odd, we'll say, I'm the guy that gets the phone call to help sort it out and correct it.
Awesome, thank you. I'll go ahead and get us started. So we just ended another ERISA season, not even a month ago. So perfect timing for this event to go over common audit findings that we see during these audits. Pretty much every year we run into issues with plan compensation definition not being followed. What that means is your plan document might say one thing, but you are doing something different. Meaning if your plan document says W-2 wages are the definition, no exclusions, but you decide that, you know, all employee bonuses are to be excluded from 401k, that's not following the plan document. So those are, bonuses are probably the biggest area where we see this with. If you have commission checks, a lot of the time commission checks get treated differently as well based on what the plan document says. But it could be the other way around as well. Your plan document could say W-2 wages, but exclude reimbursements, but you are including reimbursements. That's also not following the plan document. So it's very important to read your document, understand it, know what definition it states in there. Does it have any exclusions or not? And then review your payroll codes to make sure they're being treated correctly within the payroll system based on what your plan document says. But also make sure that what you intend is what is written in the plan document. If your intention is to exclude bonuses, but during the process of updating the adoption agreement or the plan document that was just missed, review for that. That's an easy mistake that's made when there's an amendment or a service provider change. Sometimes those things do get missed. So definitely be familiar with your plan document so you know what it states. Another thing we saw this year actually is the plan document and the summary plan description not matching up. This can happen, like I said earlier, if you change service providers or if a document is updated, one might get updated incorrectly. It's important to remember that the plan document is your guidance for your plan. The summary plan description is just a summary document. The plan document trumps whatever the summary plan description says. So make sure you review, compare the two. And just keep in mind that the plan document is the governing document, so that needs to be followed, and it should say whatever your intention is for your plan. John, I wanted to defer to you because when we do have these issues, our recommendation to the plan sponsors typically work with an ERISA attorney to figure out the best corrective action. So if you could just provide a few comments on what, common ways are to correct this.
Sure. And to back up what you said, when you're making, that vendor switch, you're moving from, somebody that's done your plan document to, you move from Fidelity, Prudential Fidelity, whoever it might be. Spend some time with your advisors, including your lawyers, to look over those definitions, because when you look at those adoption agreements, it's 1,000 check boxes, and there's 16 different definitions of compensation there, and there's all these exclusions, and things do get missed. And so spend a little time on the beginning to look at it and say, oh, okay, well, here's how we do it. And if you find out what you were doing was wrong, it's a great time to fix it now in the new plan document. Same with the SPDs, as you said. A lot of times the SPD is printed with the plan document, and if you've made a change to match your old one, it doesn't always catch up. And because the SPDs are done later, usually than the adoption agreements, people forget what they did, and they don't go back and double check, or you're relying on that service provider, the investment company, the investment service provider, to help with that. And that's not really their job. Their job's investments and administrating your 401k ins and outs, not plan documents. So if we, it's a long way to say, if we get to a point where, oh no, we've discovered an error, we have a couple different ways to fix it. One, we can do an amendment under the IRS's Employee Plans Compliance Resolution System, EPCRS, or EPCRS as we all call it. You can do what's called self-correction. If it's been a long time where it's a really material change, you may have to actually go through the formal process. And then essentially saying, oh no, we made a mistake. We excluded bonuses. We included bonuses. We've always done it this way. We made a mistake in the plan document, and now we're going to do an amendment to fix that in the plan document. If we've discovered we withheld too much money, or we didn't withhold enough money from the participants, then we've got to go back and make either a corrective contribution for that participant, or we may have to refund some money to that participant to make sure that the amount of money that should have been withheld is now matches the actual practice of the company, and also what the plan documents should say. I won't say what they do say, but what they should say. So we have to take it, we have to correct for the plan document itself, more admin behind the scenes type things where we're doing maybe a plan amendment. But then we also have to figure out, oh no, what do we actually owe this person, or what does this person owe the plan, and correct it on the participant side as well. And usually the participant side is a lot harder, because now we've got to go to somebody and say, oh, sorry, you thought you put this much money in your plan. We now have to give you $3,000 back, and you have to pay taxes on it. Sorry. Not always the best conversation to have, but it's a conversation we have to make sure the plan stays qualified.
Okay, thank you. Just another thing I wanted to add to this specific topic. We've also seen it where, your plan can have a different definition for employee and employer purposes. And we run into issues where the definition is exactly the same, but there's a certain payroll code that for some reason within the system, it's not checked to be included for the employer match, or the other way around. So that's why not only reviewing your plan document, but reviewing your payroll system and the payroll codes can save you a lot of these headaches. Just making sure that if your plan isn't calling out any wages to be excluded for employee or employer, just make sure that that's what's happening within your payroll system. And then another common finding that we have on these audits pretty much year after year is late remittances. So the IRS and the DOL, their definition for timely contributions is the earliest date that you can reasonably segregate employee contributions from your general assets. So, they might look at how long does it take you to deposit payroll taxes. We might look at past audits for timing, you know, is there a theme there? Look at the entire year for this year. And if traditionally you're within 2 or 3 days and something is outside of that time frame, we would question that, and it could potentially be late depending on what the reasoning behind that is. A lot of clients would be like, well, I was on vacation, you know, I really couldn't submit it, but a lot of the time those are still considered late because there should technically be somebody else within the company trained to remit these in the case that you are absent. So when there are late remittances, the plan sponsor needs to correct those. So that means, you know, they need to either self-correct or go through the voluntary program like John mentioned earlier. That entails calculating any lost earnings on those contributions and then depositing those into participant accounts. The late remittances get reported on your 5500. Schedule H has a question about delinquent contributions. The total amount of the employee contributions and any loan payments gets reported within that question as well. And then your plan's audited financial statements also disclose late remittances too. And then some confusion on how long those get reported. It's within the year that they were late through the year of correction. So 2021, you had late remittances and you correct in 2021, they still get reported in 21 on the 5500 and the financial statements. 2021 has late remittances, but you don't correct until 23, 2021 through 2023 still show those late remittances on there. Before I move on to Carrie, John, to talk about fiduciary responsibility and distribution, is there anything you would like to add on the late remittances that I might have missed? Oh, you're muted, John.
Is that better?
Yes.
So I hold on.
John, I'm going to mute your line on here and then your outside line should work.
How about now? All right. Is there an echo?
There is. I would go ahead and just hang up the dialed in line.
All right.
We'll get it to you later.
Okay, you want me to dial? So I was coming in and out, but hopefully I'm good now.
Yeah.
Yeah. So, you know, late contributions, as you said, big deal for the DOL. When I was at the DOL, that's one of the things they were always after is for, you know, every audit involved, were they late and how long were they late so we can collect the lost contributions. It's not a hard fix. You know, as soon as we discover we had the error, there's an online calculator that we can use to calculate those lost earnings. You know, you put in how much it was, the day it should have been paid, the day it was paid, and it spits out how much you owe. You can go through the process right there, pay any filing fees if you need to pay filing fees for the correction process. So it's not very hard, but you absolutely have to do it because that is one of the most common errors the Department of Labor finds. And it's also one of the most common errors that triggers an audit of your retirement plan. Because what will happen is you'll either see it on your 5500 if you've reported it correctly, but more likely is a participant will call in to the DOL, to the hotline they have, and say, hey, I noticed on my statements, my contributions aren't lining up with what I think they should be. You know, 90% of our participants don't pay any attention to it, but we always have the few that are absolutely on top of it to the penny. And those are the ones that as soon as they notice it's late, they call it. And that will trigger an audit because it was late. So the sooner we can correct it, the better when we notice that.
Thank you, John. And then Carrie, I'll move it on to you.
Yep. So I'm going to discuss some audit findings that we had with plan sponsors' fiduciary responsibilities. Some of the main things we noticed, and usually this happens with newer audits that just maybe went over the threshold where they had to have an audit. A lot of times we see that they're not reviewing their SOC 1 reports from their TPA, their custodian and payroll providers. You know, we suggest that they get the SOC 1 reports, read those, make sure they have an unqualified opinion, look at the testing and see if there were any exceptions. And if there were exceptions, does that affect your plan? Like, did they have some exceptions with forfeiture calculations, and might that affect your plan? In the SOC ones, we also suggest the plan sponsor get the user entity controls, look at those and document what you are doing in your offices to make sure that those are in place. We always request those, and that's one of the things we tend to give a management comment for, that the plan sponsor is not looking at those SOC 1 reports. Another one that we see, and usually again, this is typically it's for newer plans that need an audit, is they're not having regular meetings, and maybe they are, but they're not documenting those. That is a big one that, if you do get audited by the DOL, they're going to ask for those meeting minutes and what you're discussing in those. The things that we suggest that you do, at least meet at least once a year. You can meet more frequently if you want, but at least once a year. And then things that we suggest that you document in these meetings is, look at the trust report, review that, review the certification, look at your investment options. Usually we suggest maybe you have your investment advisor come in at the meetings, and potentially your TPA. So you look at your investment performance, you're looking at your fees, review your investment policy statement every so often, and review your plan documents and amendments. If you had forfeitures, make sure that you're using those forfeitures at least annually, so they're not just getting larger and larger. If there's compliance testing issues, did you make corrections? Look at your prior year audit. Did the auditors make any recommendations and get those things corrected? Another thing, look at if there's people, usually a plan can do force out distributions of under 5,000. And if you can do that, get those people out if they've terminated, because one, it just helps you not to lose track of those employees, as well as if maybe you're on the edge of not having an audit, it keeps your counts down. So, it's just a good practice to get those people out of the plan so you don't lose track of them. So those are some things that we suggest that you discuss in the at least annual meetings. Like I said, you can have meetings more frequently, but at least discuss those items and document those discussions, because the plan auditor will ask for those. And if we don't have those, then we issue a comment for those. Another thing that we notice, we always ask for the census in Excel, and a lot of times we get those, they're not tied out to payroll. And so that's a management comment when they're not tied out. Maybe our thought is maybe at the end of January, when you're issuing W-2s and W-3s, get that census in Excel, make sure it's tied out to your payroll, and then submit it to your TPA for compliance testing. This year, I know we had a few plans that were late in getting their compliance testing done by the 3/15 deadline. And then if they had errors and they didn't make corrections, they're going to be subject to an excise tax and have to file Form 5330. So it's very important that you get that compliance testing and corrections done by 3/15. And the other thing that we notice, we ask for the census, and then we ask for supporting documentation for date of birth, date of hire, date of term. And a lot of times the supporting documentation may be off just a day or two for date of birth or date of hire, or whatever the case may be. But, if it's off a year, that could really affect your eligibility. It could affect your vesting. So if you have your source documents, make sure that they agree to your census, because it could impact your plan and compliance with the plan. So those are some things that we noticed with fiduciary responsibility, some findings that we had during the year. And then the other area that I was going to talk about was distributions, loans, and hardships. So this year in distributions, we noticed several errors in forfeitures, investing calculations. And normally the plan sponsor relies on the TPA to calculate those. But for whatever reason, we've noticed that they're not always being calculated correctly. And so maybe the participant got too much money, or maybe they were shorted money because the vesting percentage was not correct. I actually had a call yesterday with the staff, and he ran into the same issue where he had two issues where the percentage was not correct. So, John, I don't know if you can provide some insight of what does the plan sponsor do to make corrections for that?
Yeah, and all I can say is it has to be the economy, but I am getting repeated questions from clients about hardship distributions. Lots and lots of people are trying to take hardship distributions right now, loans, all those sorts of things. So, people are tapping into their plans. And so these problems are coming up more and more. And, we're having people switch jobs a lot. So now we are ending up with more forfeitures on there. When you have a forfeiture issue, I always say, as Gary said, make sure your census is tied out to your payroll so we can have a good track on who's still at the company, who's left, who do those forfeitures belong to. Spot check, your auditors probably do it, but hopefully you within HR are spot checking those hire and fire dates, because those had situations where we've been off by a year or two on vesting. It makes a huge difference, especially if they leave the company and now that you're not vesting years. You've only been here, and now we've got a debate over sometimes sizable amounts of money. But if you've noticed the forfeitures, somehow they got reallocated. If you haven't paid them yet, fantastic. Now we just run the calculations again and fix it. If we've already paid out the forfeitures and we have at that point you need to go sort of like we were talking earlier. You may have to do a distribution. You may have to do a qualifying some sort of correction to match the money up where it should be. So once we realize what the real allocation amounts should be, whether it's we were off a percentage, we had too many people in there, get the right percentages, then we have to go back and start essentially reallocate the money. And so maybe some people have to give some money back. And we're not talking a lot of money usually in forfeitures, but it's more an administrative headache than anything, especially if we do forfeitures and then all of a sudden someone leaves. Well, now we've thrown other things off. So it's one of those things where call your counsel, talk to your tax advisors or your plan advisors, your attorneys. As soon as you discover you might have that error, and the IRS, for all the good and bad of it, they do have procedures for all of these things on how to correct, and you can sort of walk through them, and we can get you to the right spot on how to do it. And I'll say the sooner we figure it out, the better, because as soon as we start splitting tax years for corrections, it becomes much more troublesome. One for 5500s, two for W-2s and all kinds of things that we hopefully don't have to reissue.
Great, thank you. And then the next couple areas that I'm going to hit are loans and hardships. So, so not really errors that we found with hardships, but so a lot of plans now allow for self-certification. So the plan sponsor doesn't have to go in and approve distributions, loans, or hardships. The employee can just go in and request it. So to reduce fraud risk, we recommend that the plan sponsor go in and look at their statements regularly to make sure that something doesn't seem off or odd or unusual, and then investigate as needed. But for hardships that allow for self-certification, and John, you can jump in if I misstate this, but I believe that the plan sponsor can rely on the employee's assertion that they have a hardship, and the employee is the one that's required to keep the documentation for that hardship. The plan sponsor does not have to maintain that documentation. In case they're audited, I believe that the IRS would go to the employee for those source documents. But the employer, of course, can ask for proof of that hardship and maintain it in their files. Is that correct, John?
That's right. And so if you remember in the old days, we had to have signed certifications, and we had to sort of look into it. Had they taken all the loans, had they done everything under the plan before they jumped to the hardship. Now, as Carrie said, it's a self-certification. They just have to assert that they don't have any other money available to pay for this, whatever the hardship item is, whether it's buying a house, paying unexpected medical bills, foreclosure, those sorts of things. So what we're seeing a lot of TPAs set up with their clients is the the employee can go into the system, they apply for the hardship, they put whatever document, they put, I need a hardship for this reason. That then goes to through the system, but then eventually ends up at somebody at the company, at the employer, to actually approve, disapprove that application. And so they're still looking at, the reasons given. But we had one where someone put in that they're getting garnished for child support. Well, that's not one of the reasons you can have one, but they're like, oh, it's free money. You have to go and disprove that one. But yeah, the obligation lies on the employee to hold that money. So if they've now signed something or checked the box in the online system that they have no other funds available, it's their burden, if it's ever questioned, to prove they didn't have funds available. The employer has no obligation to sort of investigate that unless you have a reason. So if for some reason they have other money, or they have something available to pay that, then you may have an obligation. But absent any knowledge you have to the contrary, you have no reason to not believe your employee's self-certification.
Thank you, John. And then the last area, we had some issues this year with loans. Either there was miscommunication between when the loan was requested and then when the plan sponsor started the loan repayments, so they started late, was one issue that we ran into a lot. And another issue we ran into was they didn't shut the repayments off. So the loan was paid off and there was not communication. And so they kept pulling money from the participant and putting it over to the TPA. So what happened in the one case I'm thinking of, they ended up having to issue a check back to the participant for the funds that they had over withheld. So John, I hope that was correctly handled. Do you have any insight on those areas that we noticed?
So that was correctly handled. I mean, at a certain point they'd overpaid the amount of money they owed, so we have to give it back to them. And we do run into that, and usually it's a function of whoever's handling the payroll, sort of the payroll withholdings, is a different person than who's dealing with plan loans and those sorts of things. May both be in the payroll department, but they're not. There's not communication, or you have to go in the system and toggle some sort of switch in your payroll system, and something's not happening there, or one system set up for kicks off at the end of the month and the other one's the first of the following month or something like that. So there's some weird timing issues sometimes pop up there. The other issue with loans we've run into is a lot of plans have limits on the number of loans you're allowed to take, or the amount of the loan you can take, which is lower than the actual IRS limit of half your account. And we've had several clients where maybe they hadn't read the plan, or someone's new in the payroll HR world, and now we've given someone multiple loans when we were capped at one loan. And so then now we have to unwind that loan, which is very hard to do, especially for participants taking that loan because they need the money. They've spent that money. So now we're having to go back and essentially take double out of their paychecks to try and get that money back into the plan as soon as possible. But again, it's another space where if you can, spot check that census, spot check sort of your administrative procedures on how those work, and hopefully you can cut them off, before it happens.
Yeah. So that's something I would just stress, is that, plan sponsors are looking over their distributions, hardships, loans, just look at your trust statements regularly, make sure things make sense, spot check, like John said, so that you can find an error before it goes too far down the line, and the corrections are even harder to do. So those are all the items that I had. So Paul, I'm going to turn it over to you now.
Okay, great. Thanks, Carrie. My name's Paul Carl. I'm an advisor, vice president with Haran. I've been in the business for, 36 years. Started out much like John, my career with the Department of Labor for the first 8 years. So anyway, I found this information very helpful to know exactly, you know, what the auditors are looking at and finding. John, I've got a question for you before I start with our guest, Travis. Hardships, traditionally, there is the IRS safe harbor rules for hardships. But it used to be, and I don't know if it still is or not, a plan sponsor could adopt its own rules for hardship, in which case they would have to obviously verify the truth of the matter in the hardship. Is that still available to plan sponsors?
You know, it is still available. So the IRS does have a safe harbor, and there's 5 or 6 things that qualify automatically as a hardship reason. We don't see a lot of plans adopt their own safe, their own hardship reasons. And I think it's a function of 2 things. One, more and more plans are going to prototype or volume submitter type documents. So they're either getting documents from their attorneys, we're drafting documents, or they're using the documents from their vendors. And those just are not set up to administer those types of things. The systems can't do it. The plan documents don't have any provision to do it. So I think that cuts down a lot. Back in the days when everybody sort of had an individually designed plan, it was easier to do. 2, a lot the companies that still could don't want to deal with the administrative hassle. It's kind of like you said, if we're not following the safe harbor, then everything we just said about, well, you don't have to, you don't have to worry about the self-certification, they met the requirement, now you got to dig into everything, because now you've gone outside the boundaries of what the IRS sort of automatically, checks the box for hardships. And now you've created your own obligations. And so you as the employer would then have to sort of dig into, well, what is this hardship? Is it unexpected? Do they really not have money to pay? Because all the protections the IRS gives us are now gone. And so all that burden that was on the employee now falls entirely on the employer. And most plans say, you know what? No, I don't want to do that. If the IRS says, hey, we can do these 5 things and we don't get in trouble if we do these 5 things, and all I have to do is sort of check the box, that's what I'm going to keep doing. So yeah, it's out there, Paul, but it's just not something you see much anymore, except in plans that have been around for a really long time, and even they're starting to phase those out.
Starting. And I'm looking at Carrie and Giovanna just to piggyback that. And I'm guessing you did not come across any retirement plan audits that were not using the safe harbor rules.
They all use.
Yeah. No, ease of administration is the name of the game. But just literally to make everyone aware, there are some rules out there that, while maybe not popular, they are available. So anyway, well, I get the pleasure of introducing our guest, Travis Garrett. Travis is the controller for Wings and Rings, a wonderful restaurant, and he has been asked by the panel to really give us a perspective on, in particular, the view of the audit from the plan sponsor, and share maybe what his best practices are. So with that, Travis, my first question to you is, in looking over your LinkedIn profile, it looks like you worked for a CPA firm, maybe right out of college, maybe even during college. Did you have the pleasure of auditing any of the retirement plans?
I did not. So at the CPA firm, I specialized in taxes. So coming into this role at Wings and Rings 4 years ago, I talked to Yvonne and I said, look, I'm good at tax and this is going to be a struggle. So let me get all of your knowledge so I can learn this.
Fantastic. So learning by fire or by baptism, I guess, is the best way to describe it. Perfect. Okay. So Travis, you just went through an audit season on the retirement plan side. the question is, what is your process for planning for that upcoming audit? How do you try to make it as smooth as possible for everybody?
Yeah, thank you, Paul. It's easy now, 4 years later, to have a good plan in place for doing this, because it's trial and error, right? You're learning a lot of those things. So leaps and bounds growth through this. But I think some of the biggest things is familiarizing yourself with the plan. I mean, that's Ivana and Carrie, and everyone's kind of talked about that. This is something when you're processing payroll and stuff, you're hoping the systems are in place and everything's catching it properly. But just make sure you're familiar with the plan, checking in quarterly, making sure there's big things like eligibility, matching's turned on properly, distributions are handled. So kind of all those areas they've discussed, just kind of high level in it, because like they said, it's easier to spot the errors and correct it during the year than it is after the fact. Second, and kind of just understanding, what they're going to ask during the audit. In the 4 years I've been here, we've amended our plan twice. So I feel like I'm always learning the current year of what I'm doing, but then proactively getting prepared for next year when it switches over to those new plan guidelines. So really understanding what the ask is backwards and forward is going to help tremendously being successful during the audit. And then kind of with that, keeping my internal team kind of up to date with those changes. A lot of times, you're communicating with your payroll provider for some upcoming change, or making sure those payroll codes like they discussed are proper. So just kind of leveraging all of those future learnings, as you can say, and making sure you're prepared the best possible.
So Travis, you mentioned looking at things on a quarterly basis. Can you maybe expand on that comment? Are you tying numbers out quarterly so that you are more comfortable with completing and filing a year-end census? How's that process?
I am. So with the help of Ivana through prior recommendations and stuff, I kind of got a quick little quarterly check-in. We have some reports built out through our payroll provider, looking at how to review those numbers out of payroll, matching things that are coming from our TPAs, making sure records are aligning properly. So making sure, what I'm expecting to see on the census file is falling properly, making sure I have the right payroll codes grabbed properly to ensure, I have plan compensation right. So there's a lot of things I do at the quarterly point. And then for us, being the fact that we have, 4 location restaurants all in the plan, making sure what's happening outside of our corporate office, that those payroll things are being done properly as well out there. So.
Excellent. No, I would imagine just, keeping up with that type of work will make the year-end census filing easier, because that's never a fun time. But it's important, as we discussed previously, the panel discussed previously, it's important to get all the census information in so that the compliance testing gets completed by the March 15th deadline. Otherwise, there can be excise taxes if in fact some of that testing fails. So fantastic. So Travis, how exactly are you leveraging your you mentioned your auditors quite a bit and the work that they've done, but any of your other service providers, be it a record keeper, if you're unbundled, your TPA, if you have an advisor, your advisor, how are you working your service providers into the mix and helping you prepare for the audit?
Yeah, absolutely. I think it was Carrie that mentioned it about using those outside advisors and doing that if it's not annual, sometimes more meetings throughout the year. We actually have ours next week when it comes to those fund recommendations, making sure we're getting all those plan notification letters out there. So really keeping them in tune. One thing I always like to do is after our audit is completed, I always shoot all those findings over to our advisors just for their extra guidance. And we're all seeing the same thing and making the right recommendations. I think through previous experiences, Ease of administration is something I heard someone say, which is extremely important for our side. So really just full disclosure, talking to all of our outside people to get the best product out there for our employees.
That's awesome. Yeah, that's, speaking from our side, the advisor side, we actually do get invited from a few of our clients to the auditors, like summary meeting, I guess. Here's what our findings are, and this is what, the opinion's going to state, and so forth and so on. So we get to, at a minimum, listen in on a few of our clients' conversations, and that helps us really prepare our client, listen in, okay, what are they struggling with, and how can we help them, with items that they need, be it planned comp or remitting contributions more timely, whatever the situation is. So, okay, no, that's fantastic. But John, I'm looking at you. I'm gonna draw on your Department of Labor and share a little bit of my experience, and just kind of hear what your thoughts are. So back in my day, we would travel to Memphis, Tennessee in an IRS warehouse and literally manually sift through Form 5500s and look for situations where we thought, this checkbox was marked, as a red flag, and we kind of liked how it was marked in a sadistic way, I'll say that. And then we would look further at the audit report and look for the audit report to more or less corroborate what we thought we were seeing. And that's how we targeted our cases. You spent time at the Department of Labor. E-filing was taking place, if I recall correctly, at that point, and the targeting was a little bit more systematic and computerized. So my question to you is, just when you were with the Department of Labor, how much of the cases that got targeted relied on how the Form 5500 was filed, and how much of the audit report was looked at then before a case, be it a limited review or a full investigation, was over?
Yeah. I think maybe you were on the punishment detail getting sent to the warehouse in Iowa. They must have liked me a little better. I don't know. But there are three ways in general you're going to get audited if you're a plan by the Department of Labor. One, something on the 5500. Two, some sort of complaint, like I talked about earlier, a participant complaint or string of participant complaints. And then three, the national office decides to do some sort of targeted investigations. So it may be, we're going to look at everybody with this NAIC code with revenues of X, and we're just going to audit them in this zip code. But most of our audits came from 5500 issues, whether not filing incorrectly, or something flagged on, late corrections were reported on the 5500. That's probably the majority, and the other two, it's probably like 60-40 between the other two. And I think that's probably held true just in talking to friends still at the DOL. That's probably still about the same. The 5500s are sort of the leading cause, I will say, the cause of audits. But audit reports are really important, because if you pull that, if you see that something checked or not checked that you expect to see, and then you pull the audit report, a lot of times there's probably a decent explanation of what that is. And so maybe it doesn't go in the pile for audits. It's like, oh, well, they reported, late contributions. The audit report found it. They explained what happened. They showed that it was corrected, and we moved on. Versus where either the audit report doesn't mention it, or there's ambiguity, we'll say, in the report, or something like that. One of the bigger issues we used to find is they would use an accounting firm that didn't do a lot of planned audits. And so the audit wouldn't be very good. Now, if you're the employer, you're the plan sponsor, you might not notice because, you hired an accounting firm to do this, and they provide you an audit report that looks nice. And so you're okay, that's what they gave me. But then when it hits the Department of Labor, like, well, this is missing, these requirements, and it's missing X, Y, and Z. And so a lot of the ones we found, if we found something in the 5500 that then had an iffy audit report attached to it, that one went right into the audit pile for two reasons. One, to check the plan, but also, they do investigate auditors. There is a division of the government out there that, checks on auditors and are they doing things right. And so it would sort of get, fast tracked because now we have a 5500 issue, which means we have a plan issue, and maybe we have an auditor issue too, which could then also spiral into, well, now we're going to pull all the plans audited by this firm. So it's never a good spot to be in. But yeah, those audit reports are very key because sometimes that's, how well it's described or how well it's done can take you off the list very quickly because, oh, look, it was found, it was handled. Let's not waste resources on this one when we have these other ones that we're pretty sure we can find the violation on and, justify our existence as a DOL auditor because now we found violations that we fixed.
And John, just to piggyback what you said, what you're referring to is that chief accountant's office.
Yes.
That got created, I want to say in the early to mid 1990s. And up to that point, really any independent accounting firm could perform the audit. But eventually the chief accountant's office really did start to scrutinize the firms and the quality of the audits to the point where, firms like Von Lehman that really specialize in the retirement plan audit, took focus and really enhanced the process. So that's
right. Like, for example, Travis coming in, doesn't really have a lot of experience in the audit. He was hard tax side, comes in. Travis, if you had said, who's our accounting firm? And they name somebody. Well, how many plan audits do you do? And they go, we do 5 a year. You might go, maybe that's not the right company to use, especially for a restaurant group where you have a lot of moving pieces. And your testing is going to look really weird. And, forfeitures, you've got a lot. So more than, we're a manufacturing company and everybody's been here 25 years and those sorts of things. So I have been, I'll share, but I've been involved in audits that went south to the point where the Office of Chief Accountant reported. So they really do dig into the weeds on that, if the audit's very deficient.
Right.
And you as a plan sponsor don't want to be caught up in the wake of something like that.
So Carrie and Giovanna, I'm just going to ask you a quick question. Have you been contacted by the Department of Labor to perform an audit of an auditor, or is there something that is taking place behind the scenes that?
So Von Lehman has been selected as part of their process when they randomly select audit firms. We have had files selected. They literally do look at everything, but I think Carrie and I both have been on both sides, whereas a plan that we audit got selected, like the plan itself, and then an audit that we work on got selected. So we've seen both ends of it, both sides of it. They are very involved. They look at every detail, ask a lot of questions, but luckily, knock on wood, all of our audits have come clean and they were happy with our procedures. But, when we are doing these audits, plan sponsors might get a little annoyed with us with how much we're asking for support, questions, but, we have to make sure that we're performing sufficient audits, because if we weren't, like, we could lose our licenses to perform these. So we have to make sure we're doing everything that we need to. And we also want to make sure that, you know, you as a plan sponsor are doing everything in accordance with your plan as well.
Exactly. Fantastic. So, let's see, Katie, I'm out of questions. I will turn it over to you. If you want to ask people to gather final thoughts.
Sounds good. Thank you so much, Paul. And I think everybody kind of did, but that's a good point. If we could just go around and everyone just kind of give one key takeaway. Ivana, we'll go ahead and start with you.
Yeah, my key thing again will just be really understand your plan document, and periodically review those along with your payroll codes and everything, just to make sure that everything is working correctly and in accordance with your document.
Carrie, anything to piggyback on Ivana?
No, I guess the biggest thing I would say is at least meet once a year, if not more frequently, and go over those things that I discussed that you should be talking about at least annually. That I guess is my biggest takeaway.
Thank you. John?
No, I 100% agree with that. I'll take my 15 seconds and remind anybody that has a plan. Travis had mentioned notices earlier. If you have a safe harbor notice or QDIA notice, remember those need to be out to participants by December 2nd. So get on those.
Good heads up. Paul?
Yeah, you know, I really appreciated Travis's comments that some work throughout the year will make the year-end census time more efficient and help, you know, everybody, help all the providers, help the plan sponsor, create that simplicity and in effect create time ultimately, so that compliance testing gets done and it's just a much smoother process.
And Travis?
Yeah, for me, I would just say, listen to those advisors. That's why you're hiring them. They're there to help give you some good advice to keep you in line, and watch out for things that you might not specialize in, to make sure you don't run into issues down the line. So really listen to those and ask those questions if you want to understand more. I know they're there to help you for that reason.
Great. Thank you so much for your insight. And thank you for being a part of this series today. We've been doing this for several years now, but it's always nice to kind of have someone who's been a part of it, more of a hands-on experience type thing. Carrie and Ivana, thank you so much for the information today. Very informative. And John and Paul, as always, thank you. As I mentioned before, we did record today's presentation, so we will be sending that out later today or tomorrow. And anybody who is still on the call with us will be receiving CE credit. So be on the lookout for the certificate for that as well. And with that, that concludes today's event. Thanks everybody for your time.
Thank you.
Yeah.